Total household debt in the United States skyrocketed to $17.29 trillion of Q3 last year. Americans are using their credit cards more and more these days, and as a result, credit card debt alone accounts for $1.08 trillion of that total household debt, the highest on record since tracking began back in 1999 by the New York Fed. With all this debt, it can be easy to let it grow and your credit score to slip. But having a good credit score is critical in unlocking lower interest rates, higher approval odds, and even making it easier to get a job. So in this video, I'm going to be going over the 3 most important things you need to do in order to have an exceptional credit score.
But first, what exactly is a credit score? A credit score is a way for lenders to determine how much risk they should take on loaning you money. To be more specific, it predicts the likelihood a person is going to fall at least 90 days behind on a bill within the next 24 months. Having a higher credit score means that you are financially responsible and you are going to be rewarded for that. FICO and VantageScore are 2 of the most popular models used within the United States. FICO started in 1989 and is the most widely used today. VantageScore was created in 2006 and was actually a joint effort between all 3 credit reporting agencies like TransUnion, Equifax, and Experian. What makes up a credit score? FICO and VantageScore are going to vary slightly, but the 3 most influential factors for both scoring models are your payment history, credit utilization, and length of credit history. Other factors such as type of credit and new applications certainly still play a role, but they're not as influential. Taking the number 1 spot for most important factor affecting your credit score is payment history. Research suggests that your track record of paying on time is the biggest factor in determining if you are going to pay the debts that you've agreed to. Your accounts that are considered for payment history are what you would expect. Credit cards like your Visa, Amex, Discover, MasterCard. Retail accounts like your store credit cards. Installment loans like your car loan or that new iPhone that you're paying off every month. Although having 1 or 2 late payments on your credit report doesn't automatically mean it's going to be a score killer, because it is the single largest contributing factor to your score. A good rule of thumb, don't miss any. What's considered a late payment? Typically, a late payment is when you don't pay your bill within 30 days of its due date, at which point the credit reporting agencies are going to get notified. A late payment can stay on your credit report for up to 7 years, but its impact on your score will diminish over time. A tip that I use to make sure I don't miss any payments is to set up automatic bill pay on my accounts like my phone, car, and credit cards. That way, if life gets in the way, you forget to pay, you're covered. What do I do if I made a late payment? If you've made a late payment, what you can do is you could try calling up the credit card company and seeing if they're kind enough to remove any sort of late fees. If your account is in good standing with them, and this is your first time making a late payment, they'll usually waive it for you. So it's worth a try. Worst they'll say is no. And remember, even though you've made a late payment, as long as it's less than 30 days late, the credit card company will not report it to the credit reporting agencies, and therefore it will not hurt your score. Credit utilization takes the number 2 spot for factors affecting your credit score. Credit utilization is a fancy term to describe how much debt you have compared to how much you have available to you. It's calculated taking your total debt and dividing by your total credit limit. Credit utilization is influential to your credit score because it shows lenders how much you're financing your life. And if you're financing a lot of what's available to you, it can be seen as 1, you being in financial hardship, and 2, you may have a harder time making future monthly payments. Needless to say, the lower the credit utilization, the better. There isn't any perfect credit utilization number, but the general rule of thumb is below 30%. Ideally, you'll want to stay between 1% and 10%. In 2023, the average American adult had a credit utilization of 28% and rising. For some context, those with a credit score of 580 and below had a credit utilization rate of a whopping 82%. And those with a credit score of 800 and above had a credit utilization rate of around 6.5%. The way your credit utilization works is the credit card companies report your total balance at the end of your billing cycle, or otherwise known as your closing date. Your payment due date is typically 21 to 30 days after that billing cycle ends. So if you make payments before your closing date, when the total balance is reported to the agencies, you will actually lower your credit utilization. If you wait until your payment due date, your total balance has already been reported to the credit reporting agencies. Other ways to get a lower credit utilization is to make a single purchase across multiple cards. So not any single one card has a high utilization rate. For example, if you have 2 credit cards and you have to make a $1,000 purchase and each card has a $2,000 credit limit on it, it's best to split the purchase across both cards. $500 on one card, $500 on the other. That way, one card will have a 25% utilization rate on it and the other card will have a 25% utilization rate on it, rather than one single card with one purchase having a 50% credit utilization rate. Other ways to lower your credit utilization is to increase your credit limit on your cards. You can call up the credit card companies and request it, or you can consolidate your credit card debts to a personal loan. Factor number 3, which takes into account roughly 15% of your FICO score, or if your VantageScore is considered highly influential, is length of credit. A longer credit history will always have a positive impact on your credit score. Your length of credit history is typically calculated using your average age of your accounts, the age of your oldest account, and the time it's been since you've opened a new account. Although with this one, it seems like you may not be able to do much other than just sit back and wait for time to pass, there are a few things you could do to help your length of credit history. First thing is don't open up new credit accounts unless you absolutely have to. Every time you open up a new account, it decreases the average age of all of your accounts. But if opening up a new account will positively impact your credit utilization rate, and there are perks to that credit card and you're going to be using it often, then it may be worth it to open up that new card. The other recommendation is to not close out old cards, even if you don't use them all that often. Those older credit cards are substantially helping your overall age of credit. Now, you might be saying, I have an old card, I don't use it, and it has an annual fee. In this case, what you can do is you can contact the credit card company and ask them to simply downgrade your credit card to a different product that doesn't have an annual fee attached to it. Doing this does not close out your account, nor does it negatively impact your credit score in any way. If you've made it to the end of the video, I want to thank you for sticking with me, and hopefully you got something useful out of it. I'm going to be making more videos like this in the future, so if you like this type of content, subscribe down below, drop a like, and I'll see you soon. Peace.